Well, the U.S. stock market is open for trade today. We see stocks little change, just fractionally lower after the S&P 500 did book a gain of 0.8% yesterday. Some signs of stabilization, though very much continuing to be a headline-driven situation and market. So joining me now with more, of course, on the Middle East and what it means for equities is Bob Iaccino. He's with Path Trading Partners. He's a co-founder there. Bob, great to see you this morning down there in Naples, Florida, per usual for us. What should investors make of this market today?
Well, the first thing I would say is it's a low conviction statement, but it's also an easy statement to make, is I think we've seen the high for crude oil prices. Now, again, easy statement to make because we're 34% off the spike high that we got yesterday. So again, that's not a difficult statement to make, but I think it has a lot to do with where the particular war is. The point of the war, according to President Trump, looks like it's maybe coming to an end, at least reaching a peak, but it still has a lot to do with what you want to do with those 240 vessels that are currently stranded in the straits. Iran is committing to blocking the strait for the foreseeable future. So that really is the next stage of the conflict from an economic perspective. The rest of it, I have no real opinion on. I'm not a military strategist, and I'm not an expert in the geopolitics of that area. But I do watch crude oil and trade crude oil quite a bit. And I do think we've established a new range, but I'd like to see that range about $10 lower. Looks to me like we're going to be between, say, 73 and 83. I'd more like to see it between 65 and 71. But having said that, I don't think this particular price level, where we sit right now and slightly lower, would have a sustained effect on inflation. So I'm actually starting to look for equities to buy.
Okay, interesting. And that's in fact what happened in the markets yesterday, right? It was a pretty dramatic scenario. We had seen Iran elect a new leader late Sunday. Futures had pointed to a pretty dramatic drop in equities that lessened early Monday morning. And then eventually we did see the market end higher by about 0.8% for the S&P. Some comments, obviously, from President Donald Trump changing the game a bit, too, indicating that this conflict could last less than previously expected, and even at one point telling a reporter that he's thinking about taking over the Strait of Hormuz. So if you're looking to buy equities here, are there particular sectors that look attractive to you?
Well, I have two particular stocks, and they happen to be in the same sector. They're healthcare. So you saw a little bit of stability in companies like AMN Services, which is essentially a healthcare staffing company, nurses specifically. Also Way, which is Waystar Holdings. They're a healthcare software provider. So I'm not digging into the kind of sectors that have been hit hard by the conflict itself. I just think it's a falling tide sinks all boats and a rising tide lifts all boats, and the healthcare sector wasn't damaged too much. I look at some of the other stocks that I had on that didn't get damaged, that I exited because I made a profit during a falling market. One of those, for example, was a position I had in Now, NOW, which actually rallied during the drop. That's ServiceNow, by the way. That's not something I'm looking to add to. I really like that the indexes themselves held their 200-day moving average. We had been so far above those 200-day moving averages that if we got out of this conflict, or at least stabilized the conflict in a clean way, in a way that the market's perceived as clean, you could have people in the equity markets looking at this as a correction that was needed to get us off some of these elevated levels. We had stocks like Caterpillar and McDonald's, which are supposed to be defensive type stocks, at 40 and 45 PEs. That's no longer defensive. So I don't like the way that this sell-off happened because I'm against conflicts of any sort. But the fact that these sell-offs happen and the market is still kind of holding in above its 200-day moving average is encouraging to me, again, as long as we get out of the conflict cleanly.
Yeah. So I do want to talk about inflation. You've been referencing that a few times as it relates to oil prices. We are going to get a backward-looking read, that is, on inflation tomorrow with the Consumer Price Index, and then the Fed's preferred inflation gauge on Friday before a Fed decision here before the end of the month as well. What does all of this mean for the path forward for interest rates?
Well, when in recent history have you seen CPI and PCE not matter? Because as you mentioned, they're backward looking right now. The reason I say that I don't think this will be a sustained inflationary spike, this is not a pricing power scenario. In other words, if your energy costs go up, whether you deliver a product or a service, those are embedded costs. You can't try and blend that in somewhere in your cost structure. You actually have to pass some of that on. But that, very similar to tariffs, is like a one-time spike if we've seen the high. If we see crude oil continue to come off, it may be a point where it doesn't actually get passed on to the consumer. These two particular data points we're seeing do not matter. The rate cuts have been pushed out, which is why I have a small short in the Russell, which is the index that is a little bit more sensitive to rate cuts, because the cuts, if they happen, have been pushed out. But as you saw in the non-farm payrolls number, that particular set of data calls for rate cuts. But you can't do it with crude oil prices where they are.
Bob Iaccino joining us from Naples, Florida this morning. He's co-founder of Pack Trading Partners. Bob, good to see you. Thank you.
Good to see you, Kristen.
All right.